the mistress always looks hotter than the wife, you know? And actually the wife may be hotter, but you think the mistress is hotter.
When to sell a stock. This can be quite a challenging call to make sometimes. So that's what we're going to be unpacking in today's video. Different things to consider before we just sell out of a position and lock in that loss. Today we're going to be using Alibaba as an example, as I'm sure there may be a few people in this boat where they brought into Alibaba, you know, when it was sort of around that 220, 250, possibly even 250, 260. Whatever price that you brought in, it doesn't matter, the market doesn't care. That's the price that you started buying in. Whether you kept adding or selling or whatever you decided to do, that's totally up to you as well. But in today's video, we're just going to be unpacking different strategies and things to think about when you see your company that you brought into, it just keeps dropping back in value every day. We're talking 3, 4, 5%, whatever, every day just keeps dropping. Different things that we can sort of think about and reflect on before we just lock in that loss and be done with it and never buy another Chinese company ever again. Before we jump into today, guys, if you do get some value from today's video, please do us a favor and hit that like button. Helps me out a ton, helps push these videos out a little bit further. And if you'd like to see future videos, please consider hitting that subscribe button, especially if you're new here. Anyway, with that said, let's crack into today's video. So, like I said, we're going to be using Alibaba as the example today. So let's say that you brought into Alibaba back when we first learned that Charlie Munger took a position with Alibaba, come out on the 13F. Charlie Munger's taken a position with Alibaba. He was buying around that 225 US. This is on the New York Stock Exchange. Recently seen that those shares drop back in value quite substantially over the last, 2-3 months. We've seen those share prices really just keep dropping back. One thing we got to remember though, when this is happening, has something fundamentally changed with the company? This is a big thing that you need to sort of look at and try and, let's block out all the noise, which can be quite tricky to do sometimes, especially when there's a lot of news and bad sentiment out there in the market. Oh, sell Chinese stocks, that's terrible, and they're getting slapped with fines and high taxes and delisting issues and all these different things in this sort of wider macro environment. But really we need to dig past that and see, has something fundamentally changed with the company itself? Like, it's something dramatically changed. Like, I know there's a lot of risk around a lot of these things that I'm talking about today, and it's up to you to decide whether those risks are worth investing with the company. But you really need to sort of unpack it a lot more and say, look, what is happening with the company itself? Is everything still on track? What's the balance sheet like? Do they have a lot of debt? And this can be used across any company. We're just using today Alibaba as an example, but use it for any position. And quite often, especially if you have a value-based sort of investing strategy, you're going to be going against the tide a fair bit. Generally, most of the time, the majority of people, institutions will be selling this stock like there's no tomorrow. They'll be getting out of their positions. As we've seen, Kathy Wood, she's been dumping Alibaba flat out. She can't sell it fast enough. And then who knows, another month from now she might be loading back up. So you never know. But there's definitely things that you need to think about. But especially if you're following a long-term investing focus, you're not just swing trading or buy in the morning hoping to sell in the afternoon as a profit or something. We can use this as a strength essentially. So we've seen the share price dropping back. It's dropped back to 200. Oh, what do I do? Do I add more? Do I sell? I don't know, I'm freaking out. So one thing that you may want to consider, this is not selling, but this is another strategy that you could possibly implement into when you see the share price dropping off of the company that you've recently invested in, is dollar cost average into this position. You've probably heard this a few times when it's dollar cost average into ETFs and everything over your lifetime. You can also implement the same strategy when the share price keeps dropping down, and this will reduce your average cost basis on buying into this company. So let's say you started buying Alibaba at 220 and you bought more at 200 and then you bought more at 180 and 170 and even 155. You're like, holy moly, I'm loading up on this position. My thesis for the company hasn't changed one bit. I love this company. They have a good balance sheet. They've got good run rate for growth and everything else. Great management, everything else looking good. You're loading up. Your average cost basis could be back down to around that 170 mark, which you should be quite happy about. You're happy at 220, you should be ecstatic at 170, or whatever the price may be for whatever company you're looking at. So definitely another strategy you can implement there as well, averaging down essentially. I know it's not ideal. Ideally you buy it at the bottom and then the next day it goes back up. 99 times out of 100, that's not going to happen. You're going to buy in, next day it keeps dropping back. Sometimes you might bottom tick it and the next day it goes back up. Generally doesn't happen. I know I definitely don't do that. Some people manage to jag it sometimes where they can buy it at the bottom and the next day it just keeps going up and never gets back to that price. So that's another thing you've got to consider as well. If you're happy to buy that price, you'll save a little bit on brokerage costs as well, then just buy up at that one position, or maybe split it over 2 or 3. You don't have to split it over 6 or 8 or 10 or whatever it may be. But there's so many great platforms out there these days where there's some that have zero brokerage costs, so it's quite easy and affordable to buy in and dollar cost average down, and you're not paying $30 or $50 or $100 in brokerage costs each time as well, which you need to factor in as well, especially if you're only buying a small percentage. If you're buying millions of dollars, you're not going to have to worry so much about these small $20, $30, $40, $50, $100 brokerage costs. But if you're buying only one or two shares and then you're paying $20, $30, $50 in brokerage costs, you've got to factor that in as well. We're going to quickly jump over to have another look at another reason why you might want to sell out of a position. And today we're going to be looking at what Warren Buffett does when he looks at selling out of a position.
You have said that your favorite time to own a stock is forever, yet you sold McDonald's and Disney after not owning them for long. How do you decide when to hold forever and when to sell? And also, are you and Mr. Munger wearing Fruit of the Looms?
Charlie? I think I better answer the question. I can answer unequivocally, I am wearing Fruit of the Loom. And I'm not sure whether Charlie wears underwear, do you?
I haven't bought any new underwear in a long time, and therefore I'm inappropriately attired.
He's waiting for a discount. Don't let him kid you. Well, the answer, it's a very good question about selling. I mean, it's not our natural inclination to sell. And on the other hand, and we have held the Washington Post stock since 1973. I've never sold a share of Berkshire, having bought the first shares in 1962. And we've held Coke stock since 1988. We've held Gillette stock since 1989. Held American Express stock since 1991. We had actually previously been an American Express in the 60s and Disney. So there are companies we're familiar with. We generally sell, we would sell if we needed money for something else, but that has not been the problem in the last 10 or 15 years. 40 years ago, my sales were all because I found something that I liked even better. I hated to sell what I sold, but I also didn't want to borrow money. So I would reluctantly sell something that I thought was terribly cheap to buy something that was even cheaper. Those were the times when I had more ideas than money. Now I've got more money than ideas, and that's a different equation. So now we sell really when we think that when we're reevaluating the economic characteristics of the business. In other words, if you take don't want to name names, but take a stock we've sold of some sort. We probably had one view of the long-term competitive advantage of the company at the time we bought it, and we may have modified that. That doesn't mean we think that the company is going into some disastrous period or anything remotely like that. We think McDonald's has a fine future. We think Disney has a fine future, and there are others. But we probably don't think that their competitive advantage is as strong as we might have thought, as we thought it was when we initially made the decision. That may mean that we were wrong when we made the decision originally. It may mean that we're wrong now, and that their strengths are every bit as what they were before. But for one reason or another, we think that the strengths may have been eroded to some degree. A classic case on that would be the newspaper industry generally, for example. I mean, in 1970, if Charlie and I were looking at the newspaper business, we felt it was about as impregnable a franchise as could be found. We still think it's quite a business, but we do not think the franchise in 2002 is the same as it was in 1970. We do not think the franchise of a network television station in 2002 is the same as it was in 1965. And those beliefs change quite gradually, and who knows whether they're precise, whether they're right even, but that is the reason in general that we sell now. If we got into some terribly cheap market, we might sell some things that we thought were cheap to buy something even cheaper after we'd bought lots and lots of equities, but that's not the occasion right now. Charlie?
Nothing to add.
He's been practicing for weeks.
That was a great example of another reason why you might want to look at selling. So the company that you've been with, you've had them for a number of years, they're a great company, they've got good balance sheet, good management, good runway for growth and all the rest of it. Or maybe they don't have growth, but they're just a good, free cash flow generating business, and you're happy to hold them for the long term. But then all of a sudden something else comes along that it looks a lot more attractive. And we're going to be jumping over to a clip from Mohnish Pabrai here, where he sort of gives another good reason, something you want to watch out for as well. But and essentially Warren Buffett's case was he was holding a cheap company, but he was finding even cheaper companies that were more attractive than this initial company. So he was selling out of these cheap companies to buy even super cheap companies, essentially. But let's jump over to check out what Mohnish Pabrai does around this.
My question is more on the selling side. You talked earlier about the 50 to 90%. You sell at 90% intrinsic value. Now we're talking about long runways, but you keep on looking for new business opportunities, I'm sure, as well. At what point do you say, you know what? I thought this was a good business. I think it has good growth opportunities, but I got this business here that I'm looking at, and it looks like it's more valuable. How do you go about this part? It's probably selling off. I don't know how you do it, but do you sell good positions for what you think might be even better? You have any?
Yeah, it's all opportunity cost. I think those are why you get paid the big bucks. I think you have to continuously do that. But it's a difficult exercise because the mistress always looks hotter than the wife. And actually the wife may be hotter, but you think the mistress is hotter. So you got to make sure that the mistress is actually hotter, not just that you think it's that way. So anything that we know really well, we also know all the blemishes really well, right? And this new shiny thing on the side, we don't know all the blemishes yet. So that's one of the things, is that the greater your familiarity with the business, the greater your familiarity is going to be with all the, Arvind's probably really, really familiar with all the negative issues with Costco. Okay, he knows those really well. I can't believe Costco has anything negative, but whatever negative there is, Arvind's aware of. But
long lines.
I'm sorry, what?
Long lines.
Oh yeah, long lines. Yeah. Every time I pass a Costco gas station, I think I'm in some socialist country. I think I'm in Russia 30 years ago or something. I'm saying, why in a capitalist society do we have these long lines for gas? But that's the way it is. Such is life. So I think you have to be careful that you don't fall into the mistress trap. And as long as you are genuinely looking at something that is better than what you own, better value than what you own, and you consider the tax implications and all of that.
You got to love the Mohnish Pabrai example there. Anyway, guys, we're going to pretty much wrap that up for today's video. I'd love to hear from you guys. What different things do you consider before selling a stock, or do you just sell it because you want to be done with it, or whatever? I'd love to hear you guys sort of thoughts around this and things that you'll implement, other strategies and things that we can help mitigate from just panic selling because we see some bad news or someone else sells or something like that. So definitely drop that in the comments below so we can get a bit of a conversation going on around it. But we're going to wrap it up there for today's video, guys. If you got some value, please consider hitting that like button. Helps me out a ton, helps push these videos out a bit further. And if you're new here, please consider hitting that subscribe button. That way you can stay up to date when the next video drops. Alright guys, with that said, we'll catch you in the next video. Stay safe out there, don't panic sell, and we'll catch you in the next video. Cheers guys.